Hey Puppy Trades! In this video, we're going to go over how I am going to be forward testing and back testing a position that I'm going to be taking, which is 30% SBIT and 70% LFGY. And I'm actually going to use Chat-GPT to do this. So very cool video, very cool technology. New ETFs, new forward testing and back testing technology, and I'm documenting all of it on this page. So make sure to like and subscribe. First, let's go over some basics of back testing and forward testing. Back testing is applying a trading system to historical data to verify how that system would have performed during a specific period. Trading platforms generally support back testing, through which traders can test ideas and gain insight without an idea into an idea without risking funds. Related research into hypothetical scenarios include optimization studies in which a trader enters a range of data to find out what idea would have performed best, and forward testing and performance forward testing, in which a simulation of trading is done following the idea's logic. So that's what we're going to get into, is really forward testing in this video. So forward testing, also known as paper trading, provides traders with a set of out of sample data on which to evaluate a system. Forward performance testing is a simulation of actual trading that involves following the system's logic in a live market. It is also called paper trading since all trades are executed on paper only. So that's actually not going to be what I do in this video. In this video, I really am investing in this combination of ETFs. I am not a paper trader. Everything you see me do is real. Real money in a real brokerage account, and this is going to be no different. But the idea here with forward testing and back testing, generally it's for a trading strategy. Say, hey, if the RSI hit oversold and I held until it hit overbought on a specific stock, what's going to happen to my performance? Will that work with a stock like Netflix, Apple, and Tesla? Historically, it usually does. So that's an example of back testing. Forward testing would be what we're going to go over in this video, and how I use Chat-GPT to do it. So first, we're going to get into the ETFs being used. One is 70% LFGY. So this holds MicroStrategy, Coinbase, the Bitcoin ETF, Marathon Patent Group, Clean Spark, Core Scientific, Hut, Riot Mining, BitDeer Technologies, Applied Digital, and so on. So very highly correlated with Bitcoin. It even holds Bitcoin. Obviously, MicroStrategy and Coinbase hold Bitcoin. MicroStrategy holds the most. SBIT, this ETF, provides or seeks to provide, before fees and expenses, negative 2x the daily performance of its underlying benchmark. While the fund has a daily investment objective, it may be held for longer than 1 day if I believe it's consistent with my goals and risk tolerance. So that is SBIT. And now let's get into my Chat-GPT. You can tell this is my Chat-GPT because I'm looking up fault lines. I'm looking up the Applebee's location guide, all types of fun stuff. So the first thing I wanted to do is I wanted to make sure that Chat-GPT had the right ETF. I said search the internet for the YieldMax ETF LFGY. It said the YieldMax Crypto and Industry Tech Option Income ETF is an actively managed ETF that seeks to provide current income and capital appreciation by investing in a select portfolio of 15 to 30 companies within the crypto industry and technology sectors. So this ETF, I made sure it had the right ETF. It directed me to this video, and this video actually was pretty accurate as to what the yield was going to be in this thumbnail. The yield ended up being 71%. This estimate was 73%, so great job by that creator. I asked what the yield estimate was. It did not give a very good answer. I searched the internet for, I had it searched for YBTC because originally what I was doing was 30%, um, it was about 30% SBIT with 35% LFGY and 35% YBTC. So that's what it originally was. Now I do invest in YBTC. What this video is about is 30% S-bit with 70% LFGY. So I had it search for that and make sure it had the right ETFs. So that's the first step, is have Chat-GPT search the ETFs, make sure it knows what's going on. And so I said averaging into, the first thing I had to do uh, was what happens if you average into the ETFs just by themselves. And I got, this was really just kind of training ChatGPT to get into the mindset of what are we talking about. We're talking about averaging into a pair of ETFs. So it didn't realize that I was asking for a pair of ETFs. It just did them individually. So I made sure to clarify. I said, tell me what would happen if someone averaged into 25% SBIT, 30% LFGY, and 30% YBTC, and use the dividends to maintain a 15% cash position to lower the expense ratio. They planned on averaging into this forever. Assume LFGY's dividend yield is over 50%. It ended up being 71%. And YBTC's dividend yield is 35%. This is what it said. The dynamics of the strategy were the high dividends, the challenges with the leverage ETF, and the cash buffer to lower the expense ratio. Forever averaging, by continuously averaging in, the investor reduces exposure to market timing risk and captures a range of price points over time. The cash inflows from dividends may cover new investments, keeping the portfolio in balance. So I continue to train this model to get it to what I wanted it to really be assessing. And then eventually I got into a really cool I started to get these tables, right? So the next thing that I asked was, isn't this a net long portfolio? The SBIT will fall, because it was saying that the portfolio would fail during a bull market. I said, isn't this a net long portfolio? The SBIT will fall, but YBTC and LFGY will rise, and they collectively have a bigger position. Wouldn't this succeed in a bull market because the losses in SBIT are mitigated by position size, while the out of the money call premiums are reinvested into the portfolio forever? It said that I was correct, and then it went through the dynamics of the position. So I continued to train the model and get into, eventually I got into what would happen during a moderate bull market versus a strong bull market. And it talks about what would happen to SBIT, what would happen to YBTC and LFGY, but I still wasn't really getting what I wanted it to analyze. So we're going to keep going through this. I ended up asking what would happen if the Russell 2000 was added to it, 10% RDTE paired with 5% SRTY. It went through the simulations in a bull market and a bear market, a sideways market, a Bitcoin bear market, and a Bitcoin bull market. So I thought this was really where we started to get what I wanted to see. What's going to happen in a bull market, a bear market, or a sideways or volatile market. SBIT was going to lose value. YBTC and LFGY were going to rise rather significantly. And then for a bear market, the opposite was going to happen. And then for a sideways market, it was saying that SBIT was going to have NAV erosion, but YBTC and LFGY were going to generate lots of income. And basically that was going to be the same thing for RDTE and SRTY. The leveraged ETFs were going to have decay, but overall the premiums coming in were probably going to outpace that. So eventually what I got to was something really cool. It gave me a final assessment, and then I started to ask for just 70% LFGY and 30% SBIT. So I said forward test, 30% SBIT and 70% LFGY reinvested forever. It said to forward test the portfolio consisting of 30% SBIT and 70% LFGY with all dividends reinvested perpetually. The following analysis steps are necessary. It gave my assumptions. At first I had it assume a 50% dividend yield, and then eventually I had it up to 71%. So this is what it said: that during a bull market, SBIT would lose value rapidly, but LFGY would gain significantly due to Bitcoin's rise and reinvestment of its high dividend yield. Compounding amplifies the effect. And it said the net effect during a bull market, LFGY would dominate the performance, but SBIT would create a drag. Long-term reinvestment in LFGY would offset the SBIT losses. Then basically the opposite happens for a bear market. SBIT hedges some of LFGY's losses, reducing portfolio downside, and the dividend yields provide some offset as well. And then from a sideways market, it said that SBIT would suffer value erosion due to the daily resetting. 70% LFGY would create consistent income from dividends with limited price movement. So eventually, what it did is it started to put $100,000 into a simulation and go for 5 to 10 years. And then it asked me, would you like to run a Python-based simulation? I thought that was a great idea. I told him I would get the exact yield tomorrow. And then I actually had it estimate a 75% LFGY yield. And this is what it came out to. Very interesting simulation results. The portfolio's final value after 10 years, starting with a $100,000 initial investment and assuming a 75% dividend for LFGY, are as follows. A bull market gets over 30% annually. A bear market gets less than 20% annually, but still both of them were positive. So I was like, that's kind of crazy. How is a bull market and a bear market going to be bullish for this? So I continued to refine what I was asking it, making sure that it knew. And I said, yes, forward test 70% LFGY and 30% SBIT, knowing that the actual yield for LFGY is 71%. And then it gave me this graph. It said that during a bear market, LFGY was actually going to do very well. It was going to do well in a sideways market, and it was going to do well in a bull market. I thought that was kind of incredible, and I thought that was kind of incorrect, that it would be substantially doing well during a bear market. I thought it was possible because of all the premiums from LFGY and the performance of SBIT having its leverage, but I didn't think it would be that good. So it actually gave me the numbers. It said $100,000 after 10 years would turn into $35 million, and that it would actually make more during a bear market. So I thought that couldn't be correct. So I continued to refine the simulation, and then eventually I said, in the other simulation where the yield was just 4%, you said it would do poorly in a bear market. Now you're saying it will do well in a bear market. It said, you're absolutely correct to point out the discrepancy. I appreciate you for catching me that. Let me clarify the results. And so it said that this 71% to 75% difference, because at first I had it do 75%, was going to really make a big difference, which I found to be a little surprising, because it was actually having the 71% dividend yield do better. And it said the corrective approach to reconcile the results and ensure accuracy. I will rerun both simulations side by side, keeping all assumptions consistent except for the yield difference 71 versus 75. And this is what it came out to, a very awesome chart showing what would happen. I thought this was much more accurate, that during a bull market, I would see the best result. During a bear market, I would see the second best result. And then during the sideways markets, it would be the underperforming. So then it gave me this table with the 71% yield versus the 75% yield. And I thought that this was kind of incredible, that the 71% yield would do so much better than the 75% yield. And I think that that might be something to do with the distribution drop every week. If it was, if they were paying out too much of their funds, that there would be too much of a distribution drop if that was unsustainable. So it said during a bull market, the portfolio with a 71 yield performs far better than the one with a 75% yield, which didn't really make sense to me, but it said this is due to the compounding difference. At 75%, the aggressive reinvestment leads to overexposure, and LFGY's price correlation with Bitcoin creates a drag. Bear market, the 71% yield portfolio again outperforms, as the higher yield in the 75% case leads to disproportionate reinvestment, compounding losses as Bitcoin declines. Sideways market, the 75% portfolio shines in this environment where price stagnation allows the higher yield to dominate, offsetting SBIT's decay. So eventually I got it to backtest a portfolio with 30% SBIT and 70% LFGY over the past 5 years. And it said the final result was that I would have made a decent amount of money. $100,000 would have turned into $5,800,000. I guess that was coming from all of the reinvested dividends being substantial. Observations: the portfolios experienced significant growth due to LFGY's high yield and its partial correlation with Bitcoin's upward trajectory during this period. SBIT acted as a counterbalance during periods, keeping the portfolio moderately sideways during 2022. So we can see that this is basically saying I'm going to catch Bitcoin's upside, and the SBIT is going to prevent me from having these massive drawdowns that Bitcoin can have. And it even gave me a year by year showing how this was possible. $175,000 after the first year, during that incredible run in 2020, 379,000 that continued into 2021, 960,000. Year four, I must have bought the dip and reinvested a substantial amount of money. And then year five, ultimately, I somehow made $2 million from $100,000. I said, is this correct? Do these calculations include any additional reinvestments or any additional investments to the original principal besides the reinvested dividends and the initial $100,000? It said no. These calculations are based solely on a $100,000 investment. So what this is telling me right now is over the past 5 years, 70% LFGY and 30% SBIT would have made me a substantial amount of money. If I would have made $5.8 million from $100,000 from reinvesting all of those dividends, capturing the massive Bitcoin bull rally, and buying the dip in 2022. So let me know what you guys think. Is this a viable way to forward test or back test portfolios? I am going to be investing in 70% LFGY and 30% SBIT, and this was certainly part of my analysis.